What's up guys, welcome to Glory Investing Show. In today's video, I'm going to tell you how you can earn money trading options. Firstly, options trading seems overwhelming. However, if you're able to understand a few key points, you will be able to make money trading options. However, before we start, make sure you subscribe to Glory Investing Show and don't forget to hit that bell icon so you never miss any updates. So, without further ado, let's get into this. Usually, investor portfolios contain several asset classes such as ETFs, mutual funds, bonds, stocks, etc. And sometimes these asset classes also include options. Before we start discussing how you can earn money trading options, you need to understand what options are, right? Options. In simple words, they are another asset class. And when used correctly and efficiently, options can offer several advantages that ETFs and stocks alone cannot. Let me tell you that options are contracts that provide you the right, but not the obligation, to either purchase or sell a certain amount of some underlying asset at a predetermined price. You can buy options with brokerage investment accounts. Why are they so powerful? Well, the option can enhance your portfolio by offering added income, protection, and leverage. For example, you can use options as an effective hedge against the declining stock market in order to limit downtime losses. Furthermore, you can use options to generate recurring income. We can indeed say that options are insurance for investors. How to make money trading options. We will discuss how you can become a professional trader and use options to earn money. We will be discussing various ways to trade options so you can make a profit. Of course, you will have to find an options trading system, and you will need to find a market that fits your trading style. Facebook, Google, Apple, Twitter, etc. These are some of your favorite companies. Well, you use their products daily. Let me tell you that these companies have stock options. Moreover, you can trade these stock options right from your laptop, computer, tablet, or even your smartphone. Calls and puts are the two types of options. In simple words, if you purchase a call, you want the stock to increase. On the other hand, if you purchase a put, you want the stock to go down. We all know that there are two sides to every single market on this planet, right? Well, you can do the same. You can sell an option as an opening trade and later purchase it back at a lower price as a closing trade. Options prices. Before we go any further, you need to understand the prices of options. Options prices are primarily based on three different elements of its underlying stock. The first one is time to expiration. As I have already mentioned, that options are basically insurance for investors. And we all know that you need to pay money for this insurance. In the case of insurance, you don't get to pay a one-time payment, right? Instead, you need to pay monthly or yearly to keep the insurance. This means that the longer you have insurance, the more money you need to pay. Well, this is exactly the case with options. They come with an expiration date for the exact same reason you need to pay each month for your car insurance. For example, an option that comes with 60 days until expiration might cost you $1,000, when the option with only 30 days to expiration costs you $500. More time indicates that you will have to spend more money. It's worth noting that as the time passes, the time value of an option will also decay. Well, this is called time decay. Now we will discuss how the time value of an option decays over time. Here is a graph showing the relation between the time value of an option and time. So, the graph shows us that the time decay is not linear. Instead, it's exponential, which means that as we get closer to the expiration date, time decay will rapidly speed up. Here, it is worth noting that the time value of an option is always decaying. In simple words, time decaying never stops, and it can be your worst enemy if you trade options the wrong way. However, if you trade correctly, this factor can be really helpful for you. Now, most stocks have weekly, monthly, or quarterly expirations, and traders can decide which expiration they want to trade options in. With that being said, we will move to the second element, and that is underlying stock price. Well, there are many options at different price increments for each stock. These prices are called the option strike price. Suppose you own a stock at $100 per share, you can purchase the 100 put. But why? Because that is the price where you will sell your shares in case the price of stock decreases. Obviously, you don't need to own shares of a stock if you want to trade options. However, the strike price of the option has a massive impact on the price of an option. Suppose the current stock price is $100 per share. For call options, if an option has a strike price above $100, it will be referred to as out of the money. On the other hand, if it's lower than $100, it will be referred to as in the money. For put options, it is exactly the opposite case. Here, it is worth noting that if an option is out of the money at the expiration date, this option will be worthless. Since stock prices change daily, the option prices also move on a day-to-day basis. Well, if the price of a stock increases, the call options will become more expensive and the puts will become cheaper. And the last element is volatility, which is the magnitude of the price swings of a stock. In simple words, higher volatility of stock means bigger price swings and vice versa. Well, we can say that bigger volatility means more risks for a person who owns the stock. Well, options will be more expensive if the volatility is higher since there are more risks involved. But why? Well, the option seller has the right to demand more money if they're taking more risks. This makes sense, right? Okay, let me explain this to you. Suppose you're providing life insurance for two different people. Remember, I previously said that options are just like insurance for investors. Now imagine that one person is obese, smokes cigarettes, and is addicted to alcohol. And moreover, he suffers from a medical condition. We'll call him Bob. On the other hand, the second person is healthy, exercises regularly, and has no sign of any life-threatening medical condition. Who will have to pay more money for life insurance? Of course, Bob. Why? Because he has a higher risk of dying. Now think of Bob as a stock with high volatility. On the other hand, the healthy guy is a stock with low volatility. You need to understand that volatility is much more predictable. The combination of these three elements determines option prices. You need to consider all of these factors before making your trade. Final thoughts. By understanding all these points and investing your money to trade options, you can surely make a profit. Always keep in mind that anyone can trade options. However, if you really want to make a profit, you need to do it the right way. I would recommend that you first understand all the points I have discussed in this video, and then start trading options. In the end, if you're a person looking to trade for a living, you might want to consider trading options. The best part about the options market is that options are very flexible since there are so many ways to approach them. Although the process is a little bit challenging, trading options can be a great way to earn money. What do you think? Tell us in the comments below. Well, that's all for our today's video. Thanks for watching. If you liked it, make sure you give us a thumbs up and share it with your friends. Also, don't forget to share your thoughts and valuable feedback with us in the comment section below. Take care and stay tuned.